Well, thank you very much. I'm going to go through a bunch of slides. I promise I won't go through all of them. I taught a CFA class about a year ago, and I started by saying there's a mistake in the presentation, and if you find it, I'll treat you to dinner. And they found 20 mistakes in the presentation, and it was 15 different people. So I'm not going to do that today, but there is a mistake in the presentation, and maybe we'll find it together. But what I'm going to do tonight is basically give you a snapshot of what I do for my clients. And this is the same presentation that I just gave earlier on today to someone who's got 10% of the assets in the fund that I manage. And in the course of doing that, hopefully give you a sense of what you're doing today, how it can be useful later on in life if you in fact get into a position like me in terms of running money or conducting research, et cetera. So I'm going to give you basically an overview of what I'm doing today, what my thoughts are, where I think some value ideas are, how we look at names, and do it in the context of my actual portfolio. And I'm willing to actually show you my portfolio if anyone's interested after class. Actually show you some of the names that we have. I won't leave it with you, but just to give you a sense of sort of the diversity of what we're doing. I run an equity and equity arbitrage fund, and the professor was very kindly asked, can a value investor run a hedge fund, and are value investors really people that short funds? Well, I run a hedge fund. I call it an equity and equity arbitrage fund. For clients, I call it a hedge fund so that we can charge 1.5% plus 20, which is a very a good fee structure to be involved in. But it is a fund that has three structures or strategies to it. Directional investing, which is basically the core of what we do. And what's directional investing? That's just basically investing in long positions that are undervalued. And we'll get into a sense of what undervalued means in a second. It also means shorting securities that we think are overvalued or that have some fundamental problem, and there's a catalyst and it's going to go down in price. You don't always short a stock that's expensive. You'll lose a lot of money shorting stocks that are just purely expensive. So directional means that both the longs and shorts have nothing to do with each other. They're just independent ideas. We're also involved in pair trades. I'll give you some examples of those. Pair trades are stocks that are somehow related. You're long and short companies that have some relationship to each other. I'll give you some examples of those. And to me, the smallest part of what we do, but sometimes the most profitable and the funnest aspect of what we do, is arbitrage investing. And there are three things that we do in arbitrage investing. There's holding company arbitrage, there's merger arbitrage, and there's share class arbitrage. And I'll show you some examples of that. So I run a fund that really has three different strategies to it. And in these three strategies, this is really a very mathematical-based strategy. This is more of a sectoral-based strategy, trying to figure out what's going on within sectors and trying to take advantage of discrepancies in sectors around the world. And in this strategy, this is perhaps more in tune with what you're studying, trying to find a dollar's worth of assets for 50 cents. Or a dollar's worth of assets that's selling for $3 where we think it's going to go down to $1. So let's just look at some of those. First of all, the fund that we run is $1.2 billion. I used to run two funds that had $33 billion. We're closed now. We don't take any more clients, and it's a lot more fun to run a smaller product. Having $33 billion in an organization that had $90 billion, you're sort of like the elephant in the tulip fields. You can't hide. Every time you go out to invest, you have to invest a couple $100 million worth of stock. It's very difficult to run those types of money. It's much easier to get in and out of positions. There's something in my business called skid. If you make a decision and then you try to implement it, the time frame between making your decision and actually implementing it, sometimes you lose out. The more money you run, the more inefficient in many respects you are when you manage money and invest. And so for me, it's very enjoyable to have this small amounts of money. We're doing okay this year in our fund. We did pretty well last year, the blue bar on the left. That's after 1.5% plus 20. So that's a net performance fee. And we try to hit lots of singles in our fund. We don't try to hit lots of home runs. I'm going to go through most of this marketing stuff fairly quickly, but just to give you a sense of what we do, I think it's important just to look at the performance. Performance on the left is just since we began 4 years ago in this fund relative to what the indexes have done. So we've been fairly successful managing money, and we've been doing it with those three basic approaches. Now, when you combine all three of those approaches into the portfolio, this is what the portfolio looks like. If you're running a hedge fund, you want to consider what's your long exposure. So we have 93% of the capital that clients gave to us invested. That means we have 7% in cash. We have a 28% net short position. That means that 28% of the client capital that we've offset with some short positions of some type. We have a gross 121% exposure. So for every dollar of client capital, we have $1.21 invested on a gross basis. And our net, our longs minus our shorts, 65. This is the average since we've been invested. When you run a hedge fund, you can borrow money. It's a very risky thing to do. Or you can go short. That's another way of leveraging. I don't know how much time you guys have spent on shorting securities, but in order to short a security, you have to borrow it from somebody. And by borrowing that security, in effect, you've added leverage to your portfolio. So we run a fund for John Templeton. He's an investor in this fund, but we run a fund for him where he wants to be anywhere from 0 to 50% net short all the time. And that means that basically for every dollar of capital that we have from him, we have to have $1.50 short. So we're over 200% gross. So it shows you how when you start shorting securities, you can add leverage to a portfolio. And you have to monitor it. Shorting can be very risky. Or in terms of what we do, shorting actually lowers the risk in our whole portfolio. We're global. Our funds are going to be a little bit more diversified than a lot of funds that you might see from value investors that might have 20 to 30 or 40 names. We have up to 100 names in our portfolio, partly due to our universe. Our universe is so large because we can look all over the world. We may want to get involved in a particular event or theme in a particular country, and it might be easier to do it by owning a basket of stocks as opposed to a single stock, and I'll show you an example of that. But this is our long exposure as a percentage of our longs. This is our shorts as a percentage of shorts. You can see we're mainly short U.S. securities today. We have a lot of shorts in the United States. We're doing a lot in the United States today. The United States, to me, today is a very fascinating place to be investing both long and short. Now, this is our net exposure. So when you look at our longs minus our shorts, you can see that in the U.S. we are 14% net long in our portfolio. And this is all of our geographic exposures here. You can see the only country we're net short is France. We have nothing against the French. It has something to do with an arbitrage investment, which I'll show you in a minute. But you can see that we're generally long in Europe, the UK, and the Nordic region. We're generally in Asia long non-Japan. We have less than 1% net exposure into Japan. So if you look at our portfolio, and when we look at the world on a bottom-up basis, and when we're finding value around the world, it's mainly US on a net basis, but I'll show you something about that in a minute. Europe, but mainly the Nordic region in the UK, and mainly non-Japan Asia. Matter of fact, most of our exposure is in non-Japan Asia in the portfolio. Now, you guys study risk, and there's all sorts of different ways of looking at risk. And when you're running a portfolio and you're levered, and you have both longs and shorts, one of the things you have to consider is the risk. And in this case, the beta. One of the most interesting things about looking at risk and measures of risk, and particularly beta over the last couple of years, is the beta has exploded and contracted and moved around a lot in the market. Beta, as you know, is just a measure of volatility. And one of the interesting things about our portfolio is that if you look at our U.S. exposure, and this is one of the mistakes, the previous page showed we were 14% net long, this one showed we're 13, so we've gone down 1% or so. But when you adjust our longs and our shorts to take into consideration the difference in beta, the difference in riskiness between the two stocks, the difference in volatility, our net exposure drops to almost nothing. So if, for example, if I have a particular security in the technology space, which happens to be very volatile recently, and I'm negative on it, but I'm worried about technology generally, and I want to take the technology risk out of that short position, I might go long something to offset that. And when I look at those two stocks, what's important to me is to know that a dollar long and a dollar short might not be the best way to go, because if your short's 50% more volatile than your long, if you really want to protect yourself, you have to beta adjust your positions. So when we look at our short and our long positions, when they relate to each other, we try to consider the different risk characteristics of the names to determine how much should we really put in these two names, because it's not always best to just put the same dollar amount. When you look at our portfolio from a sectoral standpoint, it's pretty diversified as well. It may seem that we love financials and information technology is pretty big, and so is consumer discretionary. But that's not really the case at all, because if you look at our shorts, we've got a heck of a lot of consumer discretionary stocks short, we've got a lot of financial short, and a lot of information technology. And And this is, once again, looking at the portfolio from top down. We'll look at it in a couple different ways. On a net basis, you can see we're fairly diversified. I'd say one of the things about the Templeton group, both when we were long-only money managers and today as a hedge fund manager, is that we probably are too diversified. But that's consistent with our philosophy that the most important thing for me as a money manager is to manage my risks, not to manage my return. And there's different ways of managing your risk. And I sleep very well at night with a portfolio that has tons of short positions in it and lots of exposure all over the world, because I've structured my portfolio principally to reduce risk. And diversification is an important part of that. And there's two ways of thinking of diversification. People often think of diversification by having lots of different names. And that's certainly one of them. But you'll see in a minute that diversification for us also means diversifying away from risk. And I'll show you some ways of doing that. But in our portfolio, a maximum industry position is only 10%. That's fairly low. You'll find a lot of groups that have 20 or 30% positions. Within our three strategies, directional, pairs, and arbitrage, this is the money that we have allocated, both long and short, and just to give you a sense of how global it is. And just to give you a sense of names, and once again, I'd be more than happy to show you our portfolio. But just a couple of these names I can't talk about for legal reasons, but these is a list of some of the types of names. This is the first stock we ever bought in our portfolio 5 years ago. Yuyun's a shoe manufacturer in Asia. It makes a lot of shoes for Nike, Reebok, Adidas, Timberline. We bought it when the PE was less than the dividend yield, and it had about 15% net cash on its balance sheet. And in this particular case, this was actually a growth stock priced like a value name. Hero Honda Motors is an Indian company. Korea Electric Power, we'll talk about in a minute further on. What's very interesting about our Asian positions and our European positions is that to us, most of them are private market value plays. Most of these companies should be taken private. And I'll give you an example of a company that we have not invested in yet, which would be interesting to get feedback from you as to whether or not this company could be taken private. But this is an example of some of the names that we have. On our pair trades, I mentioned that we go long and short companies that are somehow related. So for example, we're long Merrill Lynch, we're short Schwab. We're long Freddie Mac, we're short Fannie Mae. We're long Samsung in Korea, we're short Silicon. Now we did a lot of work on Fannie Mae and thought that there was an enormous amount of downside potential in Fannie Mae, and it turns out that was the case. And we felt that because of the scrutiny on Fannie Mae and the accounting issues, that they would be required to raise their capital. And as a result, the stock would come under an enormous amount of pressure. But we were worried about the regulatory issues and the fact that Fannie Mae and Freddie Mac are political animals to a certain extent. And in order to take the regulatory and somewhat the industry risk out of this investment and to minimize the riskiness of just being short Fannie Mae, and because there was a big difference in valuation between the two names, we basically went long Freddie Mac and shorted Fannie Mae. We principally put this trade on to benefit from the decline here. And the fact that these two stocks had a difference in valuations enabled us to do that. In the case of Merrill Lynch and Schwab, Merrill Lynch trades at about 1.7 times book. Charles Schwab trades much higher than that. For the brokerage and bank names, they tend to trade on book value towards the bottom of cycles. Charles Schwab is mainly consumer play. Merrill Lynch, as you know, has investment banking and consumer plays. Our view is that the two stocks should actually have the same multiple of book. Merrill Lynch actually has a higher return on book than Schwab. Merrill Lynch has better growth prospects than Schwab, but they don't trade at the same multiple either on book or at earnings. Merrill Lynch is at about 12 or 13 times earnings. Charles is at 26 times earnings, and their earnings are under pressure and probably be cut. Their earnings are just being raised by analysts. So you have a major discrepancy in valuation there. And we can go long one and short the other and take advantage of that. We have about 15 pair positions in our portfolio today. I mentioned one of the fun things that we do as analysts is to find anomalies in the marketplace. And this is an investment that we've had in our portfolio now for about, I guess, 3 years. There's a company called Groupe Bruxelles Lambert in Belgium, and it's a holding company. And actually Power Corp here in Canada and the Desmarais family own indirectly a part of this company. They have Power Corp owns a share of a company called Bargesa, which is a Swiss company which owns shares in this company called Groupe Bruxelles Lambert. And this is a great example of what you can do in the investment business where you don't have to worry about where the market's going. You can find an anomaly in the market. You can When you study value investing, you can look at intrinsic value, you can look at discounted cash flow, or you can find a dollar's worth of assets that are sort of trading at 50 cents. And this is what this is. Now, Groupe Bruxelles Lambert is, if you have this page in your handout, it's a holding company. It owns 3.6% of ELF, which is an energy company in France. It owns 7.2% of Suez, 26% of Immerse, which is a clay manufacturer. They make clay tiles for roofs and things like that. And what's interesting is that other than these investments, the only other major investment it has is a company called Bertelsmann. It owns 25% stake in Bertelsmann, which is one of the largest media companies in the world that most people don't know about because it's a private company. It owns Arista Records. It produces the Stern magazine in Germany. It's the largest producer of CDs in the world. This is a huge media company. So if we take what the market is saying Groupe Bruxelles Lambert is worth, which is just the market price in the market today, and we subtract the market value of its holdings in these public companies. So we take the $70 a share, we take the various stock prices and shares that they own in these companies, and we subtract them. We get that the market is implying a value of only 20 euros a share for Bertelsmann. Well, 20 euros a share for Bertelsmann, when they actually acquired Bertelsmann about 6-7 years ago, they in effect paid 25 euros for it. If you took the average media company multiple today, it'd be worth 26 euros a share. And if you took the average media revenue multiple today, it'd be worth 82 euros a share. So that's interesting because you basically can go long Groupe Bruxelles Lambert, short out its holdings in these public companies, and in effect create a value for Bertelsmann at anywhere from sort of 20 to over 150% lower than it might be worth. The catalyst being that Groupe Bruxelles Lambert can bring Bertelsmann public sometime in the next year. So it's great to say, okay, you can find this valuation anomaly in the market, but if it's never going to be realized, then what's the point? The anomaly can stay there for quite some time. But in this case, we're pretty comfortable that either Groupe Bruxelles Lambert will bring Bertelsmann public, or the Bertelsmann family will buy it back from Groupe Bruxelles Lambert. And in our view, it's probably worth somewhere around 50 to 60 euros a share. So here's an investment that you can buy today for 20 euros that in a year's time I think is worth 50 or 60 euros a share. Now you can only do that if you short securities. You can go long Groupe Bruxelles Lambert, which I used to do as a long-only money manager. But it's more efficient to do it by going long Groupe Bruxelles Lambert and shorting out. And if you do the math, then that's what you're paying for Bertelsmann. So this is an example of where you can use shorting positions in your portfolio to more effectively create a holding. Shorting can be an incredibly risky thing. If you ever shorted a stock at 20 and you wake up the next day and it's at 25, and you realize shorting can be really problematic. But used properly, shorting is a tool. It's an investment tool, and it can be a value tool to help create something more efficiently. I view what I do today in my fund to be more efficient than what I did as a long-only money manager because of my ability to short in situations like this. Now my portfolio, if you look at the valuation characteristics of it, my long positions sell at fairly good PE levels on average. My dividend relative to where the markets are, and on an absolute basis, my dividend yields are pretty good. This is a very interesting column for me. And as a value investor, one of the things that you need to do is try to find out where you have the biggest disagreement with the market, or find out those areas where the market's offering you something. And to me, I'll tell you in a minute where I have the biggest disagreement with the market. It's actually the currency side. But to me, the market today is offering you lots of free cash flow. Today, for whatever reason, and there are plenty of them, the market is saying that the market is offering you free cash flow yields that are abnormal. Now, 6.5% on average isn't exceedingly high, but this is our entire portfolio. This includes Bertelsmann, which is a value play. A lot of these stocks that we bought purely on a free cash flow basis have free cash flow yields around 10%.
How do you define free cash flow yield?
Net income plus depreciation minus capex. Everyone does it slightly different, but that's how we do it. Some people include dividends, some people don't. But it's purely net income plus depreciation of the market cap. Yeah. Now, one of the interesting things is that in 1982, the U.S. stock market had a free cash flow yield of 6.7%. Now, if you go back and you open up your books and look to see where the U.S. stock market traded at in 1982, And you see where it traded at today. It was one of the most phenomenal periods ever to be involved in U.S. stocks. Now, back then, the P of the market was much lower than it was today. But I can go into the U.S. market, which is very overvalued, and find a collection of names that have a free cash flow yield that's almost as cheap as where the market was in 1982. And that shows you how bifurcated the market is. And it shows you why, and we're all biased here, but why value investing is so important. The value investors over the next 5 or 10 years, in my humble opinion, are going to have a huge advantage over other investors, because with an overvalued market, but with such spread in valuation, stock picking is going to be the key. It's not going to necessarily be asset allocation. And in a market that trades at almost 20 times earnings, with only a 1% dividend yield, to be able to find these kind of valuations, I think is quite unique. Now let me talk a little bit about the US, about the Europe, and then about Asia. Now, one of the things I need to do in my portfolio is when I accumulate a selection of stocks that are cheap, I need to figure out basically the overlying risk or the overlaying risk in the portfolio. And from my perspective, the U.S. market's an incredibly risky place. And so I need to take that into consideration when I'm figuring out whatever. It's a discount rate I want to assume, when it's the type of diversification I want in my portfolio, when it's the quality of the names that I want. I have to have an understanding of the environment that I'm in. And in my view, the environment that we're in the U.S. is very risky. You have multiples on a PE basis that are close to all-time highs. And what's interesting, those multiples are based on earnings that are being generated at companies where profit margins are all-time highs. You have a very high multiple on an earning that's being generated with a very high profit margin. So that in itself is risky as well. The other interesting thing to me as a money manager, and this is an attractive thing, but the market's not necessarily pricing risk properly. One of the biggest anomalies in the marketplace today is the mispricing of risk. You see it in the fixed income markets, you see it in the equity markets. In the fixed income market, if you look at the spread between junk bonds and treasury yields, it's less than 200 basis points. 3 years ago, it was over 500 basis points. Because there's so much liquidity in the system today, because cash is so readily available, because rates are so low, people's perception of risk and what they're willing to pay for it is different today than what it was 5 years ago. And you have to take that in consideration. From a portfolio management standpoint, there is no premium or discount between high-quality stocks and low-quality stocks. People aren't paying up for quality. And that's very important, but it's also a huge opportunity. So we have an environment where, once again, valuations, if you look at price to cash flow, they're very high. If you look at price to dividend ratios in the U.S., they're very high. And if you look at the stock market relative to the size of the economy, it's one of the highest multiples it's been, other than the peak. And this is important, too, because that means the stock market is important relative to economic activity in America. And the change in the stock market is very important. And once again, you can't sit in a portfolio of individual names and manage it and try to understand your risk and divorce yourself from general market risk. And that's one of the things that you need to take into consideration when you price. But there are two interesting things that are going on in America. And from a value investor standpoint, you can take advantage of it. And one of that, the red line, is basically the corporate free cash flow as a percentage of GDP. And remember I said there's a lot of free cash flow. And you go back to 1953 and you can see it's unbelievable how good a shape American corporations are in terms of their free cash flow. These blue bars, it's amazing how bad a shape the American consumer's in. Basically, the American consumer is spending more than they earn. Unless you're a Bahamian politician, you can't spend more than you earn indefinitely. And unfortunately, Americans have been figuring out how to do that now for quite some time. But that's unsustainable. First of all, from a U.S. corporate standpoint, one of the reasons why free cash flow is so high is because companies are very profitable right now. A lot of companies in America have too much capacity. They're generating lots of cash flow. They don't need to reinvest that in new capacity because there's already too much of it. So as a result, they have extra cash. They have excess free cash flow. And that's important to know because that means M&A activity will probably pick up. If you want to grow your business and you can't grow it by adding to your capacity because there's too much, then you need to buy capacity. So as a value investor, I know that we're in an environment where acquisitions, M&A, private market values, or M&A type valuation work is probably worthwhile doing. We can screen the world for M&A or private equity market valuations, and that's important in this environment because companies are rich with cash and they're likely to make acquisitions.
Sorry, can you explain that again? If you have excess capacity, why would you go out and buy more capacity?
Well, it's much better than taking your excess cash and building more capacity. By buying capacity, you're not increasing the total capacity in your industry. You're increasing your capacity by buying somebody else's capacity. It depends on what industry you're in. If you're in the pharmaceutical sector, for example, and you have extra cash flow, there's such a huge amount of R&D and money spent on distribution in the pharmaceutical side. If you buy somebody else's basically pipeline, you can get rid of a lot of their R&D and a lot of their distribution, and you basically can increase your capacity at a much lower cost than if you built the R&D yourself.
Okay, sure.
So it depends on what sector you're in, but basically, if I'm in the metals business, or let's say the refining business, or the energy business, I just had breakfast this morning with John Hess, who runs Amarada Hess. He views his success on his ability to grow his proven reserves and his production. And he's having a hard time finding, in the oil business, you have to drill for it. And you can expand your own reserve capacity by drilling for it. Now, if it costs you $10 a barrel per barrel of oil equivalent to find oil, but oil stocks, you can buy them at $9 per barrel oil equivalent, it's better to buy it than drill. But we're basically in an environment where, to me, M&A work is going to shoot up dramatically, and so it's not a growth stock environment. It's an environment where I should be looking at those sectors where there are too many competitors, there's lots of free cash flow, probably too much excess capacity, and that is probably a rich ground to look for potential candidates for M&A activity. The other reason why M&A activity is going to go up is because cash, a percent of market cap, look where it is, it's almost 20%. And the blue line, the growth in cash. So not only companies generating lots of cash, they have lots of cash in their balance sheets. Now, if we look at the consumer, let's talk about the consumer. It's important to understand the consumer because they're 2/3 of the American economy. And if you have a bad consumer, that's going to impact, if I'm going to look at an auto stock, if I'm going to look at a retailer, if I'm going to look at a home builder, I have to have some view of what's going on from the standpoint of the consumer to do that. But one of the problems in America is that not only are these people spending more than they're earning, but they're spending, abnormal amounts relative to GDP. There's this culture of borrow and spend in America, which is unbelievable. I work for a guy, John Templeton, who believes you shouldn't borrow for any reason whatsoever. And when I went to borrow money for my house, I was paranoid that the banker was going to call Sir John and verify my salary. I thought I was going to get in deep trouble. But we come from a culture where borrowing is a terrible thing. And in America, unfortunately, that's not the case. And the way Americans have been able to sustain this spending beyond their income is by sucking it out of their homes. So this is the portion of cash refinancing that's been spent. So Americans basically are refinancing, taking money out of their homes, and taking that and spending it. Did you have a question?
Yeah, is that a lot of that to the fact that the baby boomers are now no longer, they're starting to dig into their savings, so they're able to spend more because they've saved up over time. So that's part of the reason why it's distorted a little bit.
Well, they certainly, their savings in America are negative, so they're no longer dipping into their savings. They're creating a savings pool on the value of their home. And what this is the home equity loan spent as a share of consumer spending. So basically, almost 1/3 of the increase in consumer spending over the last 5 years has come from equity being taken out of your home. So yes, demographics play a role in the increase in spending generally, and also demographics play a role in the increased home ownership in America, as do low rates. But from my standpoint as a money manager, I'm trying to look for changes that are going to occur, and I'm trying to look at the sustainability of those changes. And to me, I have to also look at the risk environment. Risk doesn't necessarily mean beta, it doesn't necessarily mean discount rate. It also means the general business environment. And to me, we're in a business environment where the consumer can't sustain their spending. I'm not saying it's going to collapse in the U.S., but you have an environment of spending that's unsustainable because it's being generated mainly by debt accumulation, and that's a huge problem.
Just going to ask you about that. Is that somewhat mitigated by the fact that a lot of that kind of equity value has been built up over the last 5-6 years in terms of the real estate market?
Absolutely. Got a couple. You've been cheating. You've pulled a couple slides in advance there, but that's exactly what's happened. Household mortgage borrowing has gone up, and house subprime origination has gone up, and we'll see in a second consumer credit as a percentage of personal income has exploded, going back to 1965. And also mortgage debt as a percentage of personal income has exploded going back to that period. Debt servicing is up. 13% of disposable income is now being used for debt servicing, despite the fact that interest rates are at a 40-year low, or a little bit off a 40-year low. And one of the reasons is because of the buildup in equity value in homes. And this is the cumulative 5-year growth rates in land and home prices. And this growth back here caused a real estate problem in America in the 1990s, and you can see what's happened here. And this seems like a lot of top-down analysis to go through for a value investor, but it's very important to understand what's driving sales, revenues, cash flows, and whether or not those are sustainable. You can't discount a cash flow from the future until today so you get some sense of how that cash flow may change over time. And so it's very important to look at that. Now, one of the most amazing things to me is home prices in some particular areas. In California, I don't have the exact number off the top of my head, but it's something like the median income in California is something like $20,000 less than the level that's needed to buy the medium home. So you've had just enormous increases. And as a result, U.S. house price to income ratio today, if you go back to the 1970s, you can see it's just exploded. So this is incredibly important for me because if 2/3 of the U.S. economy is consumer discretionary names, and if a lot of consumer discretionary names look expensive anyway, and it seems like a lot of it's from this unsustainable spending that's going on, and 23% of the market is finance-related securities, there's a lot of risk in the system. And today, in my view, this is one of the most exciting times to invest, and it's also one of the most dangerous times to invest since I've been doing it since 1985. And the risks in the U.S. stock market today, you know, I was investing in Asia, in Hong Kong in 1998 during the Asian crisis. And I became the largest investor in Hong Kong, other than the Hong Kong government, in my fund in Hong Kong during the Asian crisis. So I understand crisis. And to me, there's more risk in America today than there was in Asia in 1998 during the Hong Kong crisis. Now, Europe, when I look around the world, I looked at this free cash flow story applies in Europe as well. And if we do a lot of screens in our company to try to narrow down the universe of stocks to work on. And if we do private market value analysis, looking at free cash flow, discounting free cash flow, looking at capital structures of firms, and the amount of free cash flow a firm will generate over a full business cycle relative to the enterprise value of a firm, then some of the best private equity potential for us is over in Europe. Europe has a lot of free cash flow relative to the U.S. The PE ratios are very low, and relative to the U.S., the dividends are very interesting. Now, for us, it's mainly a Nordic story. This is the slide of the Nordic region. The yellow line is the free cash flow yield, so that's free cash flow over market cap. And you can see it relative to history, and you can see that in the Nordic region, they're starting to return that cash to shareholders. And there's a lot of things that we do in terms of discounting free cash flow out into the future and trying to find payout ratios and how payout ratios might change so that actually some of that money comes back to us. Now, payout ratios will only change if we understand the dynamics of the industry that the company is in, because if it needs to build capacity as opposed to buy it, or if it's going to buy it as opposed to build it, or if it's not going to do either of the two, that'll impact how much of that free cash flow will end up in my pocket as opposed in the hands of the manager. And sometimes I'd rather have the manager run the capital. In other cases, I'd rather get it back myself. I'd rather have Warren Buffett manage the capital, but if you're going to have a firm who doesn't have a very good track record of managing the capital and making acquisitions, I'd rather get that money back myself. And in the Nordic region as a whole, what's amazing is that the Nordic region probably will be debt-free, be absolutely no debt on a net basis by the end of 2007 because there's so much free cash flow being generated out there. So to us, free cash flow is a very interesting story all over the world. And it's one of these things that the market's offering us today, and it's one of the things that we're spending a lot of time on. Now, just quickly in Asia, Asia is a very volatile market. This is just Asia, the price index going back to the Asian crisis. And this was, part of the Asian crisis. And I bought a lot of stocks here and suffered with them until they got down here. And you can see an enormous amount of volatility. What's interesting is from 1987 until today, the market's basically flat. Now, that's amazing because if you were investing back then, you know that back in the 1980s, you had a huge drop in earnings growth, and you can see where earnings growth is today in the market. You could look at free cash flow to sales, and you can see that back in this period here, you had negative free cash flow, and today you see you have positive free cash flow. So you have a market that's basically at the same price level it was back in 1998, but the dynamics are completely different. Companies are generating more free cash flow for every dollar's worth of sales. This is particularly the case in Singapore. I've just taken one country here, and you can see how free cash flow to sales has increased quite dramatically. And not only is this region at the same price and it's more profitable, but it's doing it with less leverage. And that's interesting because return on equities are getting better, free cash flow is getting better, but companies are doing it with less leverage. And that's an important thing to understand. Sometimes you can generate higher returns if you increase your leverage. If you do the DuPont analysis, if you break that out into the components, you notice that if you change leverage, it can change your return on equity. Well, in this case, return on equity is improving while leverage is going down. And in some cases, it shows you the quality of that. You can see here the return on equity. This blue line is Asia ex-Japan. This line here is the United States. And it's amazing that in America, the price to book is close to 3 times. In Asia, it's half of that. Yet return on equity is about the same. And remember, that return on equity is being generated by declining debt, where in America it's being generated by rising debt. So in my view, one of the most interesting things around, and I think you'll see more of it over the next 6 to 12 months, is that emerging markets have always sold at a discount to the developed markets because of the risk premium. And if you look at emerging market debt, it is always sold at a yield premium to U.S. debt because of the risk premium. You could argue that America should trade at a discount to the Asian region because of the risk of America. And so this is something that we see and means that I'm willing to actually take more risk in my portfolio in the Asian region because it's an environment that's less risky. I'm willing to take less risk in my portfolio in the U.S. because it's an environment that has a lot of risk and potential more volatility in the stock market, the equity markets. And I think that's very important in terms of how I factor in my risk. Not only are the companies getting better in terms of their fundamentals, but the countries are getting better. This is a slide of reserves. This is, if you went back here during the Asian crisis, it was even lower, but you can see that the countries themselves are getting much better, as well as the companies. And if you look at Japan, this is the financial leverage in Japan coming down, return on equity going up, sales to assets remaining flat, and net profit margins going up. And these are all, once again, components of sort of the DuPont analysis to give you a sense of how companies are generating returns, which are very important for the region in terms of what we do. The other thing that's very interesting to us is this is just Japan restructuring. Japan, if you've ever been to Japan, needs to restructure. The whole economy needs to restructure. And in order for us to go and spend an enormous amount of time in Japan, we need to see restructuring occur, or sort of a waste of time to go over there if there isn't this culture of restructuring. And this just basically looks at the change of personal expenses in Japan for non-financial corporations by size. And what this basically says is that smaller companies in Japan are restructuring, bigger companies aren't. So if I'm going to go to Japan and I'm going to spend a week in Japan, I only have a week to spend in Japan, and I know that basically large companies haven't been very successful, and I've screened Japan and I've got a whole list of things I want to do, I'm probably going to concentrate on the smaller cap names over there because I know they're doing a better job at restructuring, which is something the Japanese need to do to become more competitive. It helps narrow down my focus. Japanese free cash flow, once again, this whole issue of free cash flow is changing. Now let me just skip ahead a couple slides because we don't have too much time. But I mentioned that the Asian region is cheaper. This is just the price to forward earnings. This was the Asian crisis back here. And you can see that even with the SARS problem that we had, where stock prices are today relative to history, very interesting region for me. Same thing on the price to book. It's below average, but remember, return on equities improved quite dramatically. And when I look at the region, if you look at price to earnings, Asia and then Asia ex-Japan, when you take Japan out of the equation, you can see there's a big difference, but there's also a big difference in countries. And most of our investments in this region today are in South Korea and Taiwan and Singapore. We don't really have much of it all in Japan, India, and Hong Kong, and that's not because we saw this slide and decided that's how we invest. We basically went there and tried to find good value, and most of the value we ended up finding basically in these two markets. Our average dividend yield between our Taiwanese and our Korean names is almost 6%. Our average free cash flow yield is about 10%, and our average PE is about 9. And our average stock has cash on the balance sheet. It's really quite amazing in this environment you can do that. And most of the reasons are those companies are in the mature stage, and they're starting to give cash back to shareholders. So they're being priced like bad bonds when in fact they're not. It's just the same thing in price to cash flow, same thing in dividend yield. And this is interesting too. This is the percentage of stocks with a dividend yield greater than the 3-month interest rate. Why put your money in the bank in Asia if basically 40% of all the stocks there have a dividend yield better than what you can get in the bank? And it's sort of an interesting statistic out in that region today. So this is how our portfolio is in the region today and how it's changed. This is where we were last year. This is where we are today. We've got a lot of money in Asia. From our perspective, once again, I'm willing to take a bit more risk in Asia because I think the risks generally are lower there. And also you can see that we're probably a bit too diversified. Our net exposure by energy, it's mainly domestic, and this is actually by design somewhat. One of the big risks in Asia is the China and the growth of China and the fact that Chinese growth rates may slow dramatically. So one of the ways I can get around that is by investing mainly in domestic plays rather than exporters. Financials, consumer discretionary, and telecom, these are domestic investments. These are investments that are more geared towards what's going on within the countries as opposed to what's going on with China. China is such a great growth region, growth part of the region. This goes back to how do I eliminate risk in my portfolio? Well, it's a cheap region, a lot of cheap companies, but one of the risks for Asia is China. Let me eliminate that risk by basically concentrating on consumer internal domestic plays in my portfolio. Now, just very briefly, sectors around the world that are interesting to me. Telecoms are very interesting. During the bubble, telecom companies spent more money than God. It was just unbelievable how much capacity they were putting everywhere, the amount of fiber that went in the ground. They don't have to build out capacity anymore, so they have an enormous amount of free cash flow, and in many cases they're giving that back to shareholders. It's a very interesting sector. It's a place where we have a lot of money. It's a place where the enterprise value is not going to change, but the components are going to change. Enterprise value is market cap plus net debt. And a year from now, a lot of these firms will have the same enterprise value that they have today, but it'll be more equity and less debt. And I think it's a very important, interesting place. We're also very active in pharmaceuticals today. I think what we try to do is sort of buy fear and sell euphoria. And today there's a lot of fear and uncertainty in the marketplace relative to pharmaceutical stocks. They're pulling drugs. There's a lot of competition. And as a result, if you look at where their PE is relative to the market, it's pretty low on a historical basis. What we do basically is take a stock like Merck, try to figure out what the liability is of pulling a drug. We try to find out what the past legal payments have been for deaths and other issues associated with the drug that's been pulled. We try to calculate that. We try to give a parameter, a low and a high. We try to strip that out of the market cap or out of the cash flow or the earnings, or we add debt into the balance sheet to make a liability payment like that. So we actually try to figure out, okay, the market's worried about something. In this case, it's a drug that's being pulled in the case of Merck. And we try to physically analyze what that might be. My first job at Templeton when I joined was to figure out the liability for the Bhopal disaster for Union Carbide. It's a terrible thing, but that was my job. So John came to me first day on the job and said, we had this disaster. You figure out what it means to Union Carbide, what it means to their balance sheet, their income statement, their cash flow over the next 5 years, and whether or not this is an opportunity to buy into Union Carbide because the market's just basically dumping the stock. The most excited I ever saw Sir John was in the crash of 1987, probably due to the fact that in May of 1987 he gave me all his portfolios, so he wasn't running money when the crash occurred, but also he just felt it was an enormous opportunity to buy stocks now into the portfolio. So to us, there's a lot of fear and uncertainty in the pharmaceutical space today, and it's a great place to go and look because of that. This is just dividend yields. Now this is a really interesting thing, and maybe I should end here. The energy sector is fascinating to us, and we had at the beginning of the year, about 12% of our portfolio in energy, and today we have about 4% on a net basis, but we have a lot of money in energy. And the red line here is the oil price discounted in oil stocks. So basically what it is, it's a discounted cash flow it's basically taking the current market cap of the stock and saying what oil price are they assuming if you do a discounted cash flow analysis of these stocks. So basically the market is pricing in $28 oil for oil stocks. If you analyze the company, if you took on average an oil company and you did a discounted cash flow, in order to get to where the stocks are today, you have to assume a $28 oil price out in the future. To us, that's too low. It's too low for a number of things we'll see in a minute. What's interesting is this is where, over the history, going back to 1998, where the market has discounted oil. The price of oil tends to move much more rapidly than the oil that's being discounted in the oil stocks themselves. And every once in a while, this gets very wide, as it did back here, where you could buy oil and short the oil price. The blue line is the 1-month future oil price, basically the spot price, and the yellow line is the 12-month future oil price. So basically, the equity market doesn't believe the oil market. The oil is today is priced. This slide is too old. We did this at the end of the year. Oil is up here somewhere now. Oil is at 55, I think, 54, and this has moved up to about 30. So this spread between the oil price being discounted by oil stocks and the actual oil price is as wide as it's ever been. I mentioned I had breakfast this morning with John Hess. I wanted to do two things. I wanted to thank him for having money in our fund and to tell him that we were doing this fine, but I wanted to get his sense of what was going on in the oil price, where he felt oil price should be, ex speculation, and what he was actually selling oil for, because the price of oil and what we actually sell oil for is not necessarily always the same thing. You might think it is, but he's actually has, when he delivers oil today, because we're in a change in the season of use of oil, going from heating oil to gas, et cetera, there's an increasing inventory of oil in the marketplace today. And as a result, even though oil might be at 54, when he delivered, he's only getting about 52. He's discounting physical commodity when he delivers it, which is interesting. So in my portfolio, I don't believe the oil price is going to 28 or 30 bucks anytime soon. So I think oil stocks are very cheap, despite the fact that they've run. Some of them are up 20% this year. But it's a very risky place. And I don't think oil stocks are going to outperform if this comes down, even though I don't believe this is going to come down to 28. So what do? Well, I go along oil stocks and I short the oil price. Basically, I take advantage of that spread. And to me, I've captured a spread. Now, I did it 3 weeks ago, and the oil price went from 52 to 57, and I wasn't doing very well. And then it fell about 9% in a day, and I sort of was back to breaking even. But in my view, earnings estimates this year, too, if you go and you analyze all the earnings estimates for the oil companies, they're all based on oil price around 34, 35 bucks. So earnings estimates for this year, if oil averages 35 bucks for the year, the earnings estimates would be right. But having gone through 1 quarter of the year, with oil where it is, oil would have to fall in the 20s in order for oil to average $34 for the rest of the year. So earnings are too low for these companies. They're discounting a price of 28, which I don't think is right. And you have this massive spread.
Just so I understand this correctly, well, you basically cap your upside, right, by capping the spread, and you, on the off chance that oil prices go through the roof.
So it's not an off chance.
Well, more than $5 or $6, but really hit it. You're, I guess, increasing downside risk while capping upside risk.
Well,
I know you could think that I know more than you.
Hey, you could, not necessarily in this topic, but you might know more than me in other topics. In this particular example, I could lose a lot of money, even though in some cases I think I've lowered my risk. Okay? I had a position currently, I had a position that was 12% energy. Okay? I make good money in that position, but I'm worried about it. So I trimmed some of it. I actually took my long position down to 10. Now, then I hedged some of the position by, in my view, I hedged some of it by shorting the oil price. Now, if oil price goes to 65 and my stocks don't do anything, I'm going to lose money.
So
I'm not hedged anything.
So how much cash do you keep on hand for margin calls?
I don't have anything on hand for margin calls because when you run a portfolio like we do, no, you have to worry about that. But you use a prime broker. In our case, we have 2 prime brokers, Morgan Stanley and Goldman Sachs. And your prime broker also happens to be your custodian. They're the custodian of your assets. And what they do is they look at your entire portfolio rather than one particular trade. So in this case, I don't have to have any cash set aside for this. But I do, if I shorted oil, I've sold it, and I've received that income. And that's held in my portfolio, and I earn LIBOR minus a certain rate on that. while I've sold the oil. But in my view, doing this is much less risky than just being long energy stocks, because I view what a lot of hedge fund guys have done today is they've shorted the dollar and they've gone long something else, mainly a hard commodity. There's a lot of portfolio managers out there in my business, in the hedge fund business, that are macro guys, and they don't like the dollar, so they're going to short the dollar. They get proceeds from that, and they go long the Canadian dollar, or they go long a commodity, or they go on an equity market, or whatever. And a lot of guys who are short the dollar are long oil. And if you notice, Greenspan came out about 3 weeks ago, and he talked about this conundrum that was in the marketplace. That was a very interesting thing for me, because what he was saying was that his job as the Federal Reserve governor was to try to take liquidity out of the system by raising rates. But most liquidity in the system is geared towards the bond market, not necessarily the federal funds rate. And while he was bringing rates up in the federal funds market, the bond market was coming, the yields or rates were coming down. And since mortgage rates are based on the 10-year Treasury note and not the federal funds rate, he was basically had no impact on the system. The bond market was diluting anything that he was doing. So he was putting a shot across the bow of professional money managers. He's basically saying, look, rates need to go up. And I'm raising rates, and the bond market's not reacting, and this is a conundrum. And to money, if you notice, the markets turned around then because they realized that he could come out and raise rates 50 basis points and people could panic. And most hedge fund managers, being short the dollar and long something else, mainly oil, started to unwind those trades. So for me, I was much more comfortable putting this trade on because I know, by talking to a lot of people in the business, how long a lot of people are. The difference between where oil is today and where it should be if there wasn't speculation in the market is about $15. And I spent over an hour speaking with people at Hess today trying to figure out if that assumption was correct. And they would agree. Without market speculation, the oil price would be around $40.
Now, this is the fact that Morgan Stanley is like you guys work with Morgan Stanley. I guess that's unique, like because Templeton is Templeton. A lot of companies don't have that safety net where they will have margin calls. Is that right? Like this is a fairly safe play because you're not going to get whacked on.
No,
margin, right?
no, they run a business, and if they need to call our margin, they'll do it. But you asked me if we had set aside particular cash relative to this investment, and they look at our portfolio as a whole in terms of margin, collateral relative to short positions and required margin. They don't necessarily look at a specific trade.
But I'm saying, like other companies that
It
are similar,
it would depend. If you ran a $10 million fund with Morgan Stanley, you'd probably be different. Yeah. Yeah.
So you said you short the oil and then you buy the stock at the lower discounted rate, right? How would you know how much oil to short for a per share unit of an equity? Like, is there sort of a balance between the two?
It's a feel. It's Moses. Yeah. It's it's not a science. It's not an exact amount. You have a portfolio. Portfolio is a canvas. One of the funnest things about this business is this is not like being an architect and you can push your plans and go away for holiday for 2 days. When you come back, you pull your plans out and you just start drawing another column. Your portfolio is organic, and it moves and it changes, and so you have to look at the risk in a particular trade, but you have to look at it relative to other things that are going on. So one of the I wake up every morning, I try to figure out a number of things, and one of the things I try to figure out what's different today than yesterday that's significant. And in my view, one of the most significant things that's going on today that has occurred just in the last month is that liquidity is changing. We've been in an environment where there's been too much liquidity around the world. Interest rates have been too low. And this liquidity has found its way into financial markets, into the housing market, different places. And that's really important because when you have too much liquidity, it changes people's perception of risk, and it changes the way that what they will pay for risk. And to me, liquidity has changed. And that's why when I look at my portfolio and I try to determine, okay, I've got 10% energy, what am I comfortable with? I'm not comfortable with 10% energy. Why? I can't tell you. I'm just not comfortable with having 10% energy. Should it be 8% or 6% or 5%? Well, a couple things I look at. First of all, I know that within my energy, half of it's actually gas and half of it's actually oil. So my 10% energy exposure that I have was half natural gas, half oil. I'm more comfortable about the gas market than the oil market. So if I lower my position by selling a few things and I add some so-called protection by shorting the oil price, and I bring my total exposure down to 5 or 6%, my real oil exposure, integrated oil exposure, is probably only 1 or 2%. The rest of it's natural gas. And I'm also looking at that relative to other things that go on in the portfolio, because one of the reasons why this trade will work is because of a change in liquidity, higher rates. That's going to help my consumer discretionary shorts. That's going to help my financial shorts. So it's throwing the canvas out and looking at all the different things and having them change and trying to figure out what you're comfortable with as a whole. I know that doesn't answer your question, but it's the hardest thing to explain or teach. I'm sorry? Yeah. Well, just if you looked ahead, I mean, we're still fundamentally bullish about energy longer term, but think that this risk is a very short-term issue as some of the speculation in the market unwinds. So if I was going to run my own money and not worry about having to report to clients in 6 months or a year, I probably wouldn't have changed my energy exposure. But I feel that there is risk in the short run to this energy exposure, so I have changed it. In the long run, I'm very happy with it because of the changing demand dynamics. I'm happy with it because of the changing dynamics of spare capacity, basically shrinking share capacity. Markets like Indonesia, which used to be exporters, now importers of oil. I'm happy with it because of the upstream driving costs. The fact that, upstream costs are going up, which supports a higher oil price. I'm happy with it because valuations, if I look at the average valuation, even though they've run, it's still not sort of out of line. And I'm also happy with it because relative to enterprise valuations and P ratios, some of these stocks are still very interesting. You mentioned Petrobras down here. And you can see it's sort of completely out of line in terms of its valuation. And I'm also happy with it from an acquisition standpoint. And this is a slide that shows organic funding and development costs versus acquisition costs, and basically showing that it's cheaper to buy versus than to build. But did you have a question specific to the sector, though?
Are you focusing more on production or P&D or operation?
It varies by company. In the case of, say, Amerada Hess, they are changing their production profile. They've basically sold mature fields in the Gulf of Mexico, and they are taking those assets, the cash from those assets, and trying to develop fields in Libya and other places. Now, in my view, although they're getting into less mature fields, they're also more risky political investments. So it varies. We're looking at not only companies that are changing or growing their production ability by growing the reserves, but we're also looking at, if none of these major oil companies change the capex that they will spend today, all of them will have net cash on their balance sheets in about 2 years as a whole. And so to me, M&A activity will pick up, but also exploration and production will pick up. So one of the stocks that we have in our portfolio is Weatherford. Weatherford is a company that is in the E&P side of the business and will benefit from what we think will be a massive amount of money being spent on E&P. A lot of these oil companies are using $24, $25 oil as a target rate when they determine whether or not a project is feasible. Now, even today, Mr. Hess will tell me, well, that's the target rate, but we know it's too low. And if we find something where, it'll be 28 or 29, we'll probably do it anyway. They realize that their own internal target rates are too low, and they also realize that there are a lot of fields out there that they can go out and build and expand. So we're actually shifting our exposure more towards those companies that are going to benefit from CapEx, like the Weatherfords of the world that help with drill bits, as opposed to the E&P companies per se, because they'll benefit from all the free cash flow in the system. Yes, sir.
Most of your analysis seems to be done on the macro level rather than the micro level. As a value investor, most of what we've been taught is much more micro than it is macro. So how do you balance that?
Actually, I spend 2/3 of my time on the individual stock and 1/3 of my time on the macro. It's just that I can't sit here and go through balance sheets and income statements for 100 different companies. So it would be really boring, I think, to a certain extent. So, we build our portfolio on a bottom-up basis. But you can't divorce yourself from a top-down issue. You're going to study an oil company and determine whether or not it's a good investment. You have to have a view on the oil price. So you have to have an understanding of the supply-demand dynamics in the oil sector. You can't divorce yourself from the top-down. What we don't do, one of my biggest competitors when I used to run the Templeton Foreign Fund, and is a big competitor now in the hedge fund side, is a guy by the name of Barton Biggs. Barton Biggs is was a chief strategist at Morgan Stanley. He now runs a hedge fund, about $3 billion in size. He buys no stocks. He makes an asset allocation decision, then he buys or sells indexes. That's taking top-down to an extreme. He has a view on where the dollar is going to go, blah, 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 et cetera. He never translates that into an individual company. We start with an individual company. Where can we buy $1 worth of assets for 50 cents? If I gave you a list of how many stocks out there traded at 50 cents but have $1 worth of assets, it would shock you. But 90% of them are junk, and they deserve to trade at 50 cents. Our job is to find those that don't deserve to trade at 50 cents. Then we have to figure out why they're at 50 cents and why that might change. And we can't do that in isolation to the company. If I want to do a discounted cash flow in the oil sector, I have to understand where the oil price is going and discount that back to today. So one of the joys of what I do today is that we don't take new clients. We only have 20 clients today. We have a small fund. We have a lot of flexibility. I spend 90% of my time doing research. I travel about 120 days out of the year. 90 of that is for research. When we go and visit companies, we rarely sit across the desk from management. We tend to go into a factory and try to understand the business that they're in. If we're investing or looking at a plant company, a car company, we want to know, are they having problems getting steel or the engines or the door seals, and that sometimes leads us to something else. So I could not do what I do today if I didn't go to business school. I'm not just saying that because I'm teaching a business school class. If I didn't understand the principles of the tools that you need in order to do the analytical work. You can't go out and invest around the world if you don't know how to do discounted cash flow, if you don't know what intrinsic value means. But you have to understand that the biggest area I think where academics falls behind, if I could be so bold, is in the understanding of risk. Because to me, risk is a very difficult thing to explain in a portfolio. You can look at calculations of risk as they are applied in the academic world, and you can look at if you're discounting cash flow from the future to the present, you can take that into consideration in how you discount it. But there are other elements of risk that you need to consider in the marketplace that are much more sort of generic, that are hard to quantify and teach in a business school environment. You don't understand them until you go out in the real world and you buy a stock with a dividend yield that's higher than the PE. It's got half of its balance sheet in net cash. It's growing at 20% a year, and you lose 20% of your money. And you think, this is stupid. And then you understand, well, the reason why I lost 20% of my money is because the international community thought that the Hong Kong peg was going to break. And that was a risk that the market thought was going to be there that I didn't take into consideration. Therefore, I lost 20% of my money. It had more to do with people's perception of whether or not a peg would break than had to do with the underlying value of that company. Now, eventually, it had more to do with the underlying value of that company. But eventually was a year and a half. And in my business, a year and a half could be a real long, painful time. So we spend an enormous amount of time on individual company analysis. And that's what we do. And that's the best way of minimizing your risk is to know. When people ask for the risk dynamics of my portfolio, I ask them to name a stock. Because I can tell you what the downside risk is on all of my names. In my view, that's the best way for me to understand company-specific risk is how much money am I going to lose on that name. If it doesn't work out, what's the potential downside on that? And the other thing about risk, too, that you learn very quickly is if you don't understand why a stock's moving against you and you hang on to it, that's one of the most risky things you can do in a portfolio. You buy a stock on these criteria, it goes against you, and it keeps going down, and criteria still seem to be there. It means you not necessarily haven't done your work properly, but perhaps you don't understand the risk dynamics of that investment. So, I could have changed my presentation to show you a bunch of intrinsic value and discounted cash flows and things of that nature. Maybe if you invite me back sometime in the future, I'll do that. Yes, sir.
In your presentation, you talked about like the European market has a higher free cash flow yield, and at the same time, relative to the U.S., they have a very low level P ratio. So I was wondering, like, for value, in terms of value investing, because I can easily assume that you may have increased your long position in the European market. So I would like to know more about what industry would you recommend, like, to study, to go over, because it must be very interesting because actually you're paying less than for more earnings in the European market.
That's right. Europe's interesting because in theory you are, but in some senses I actually think that it's very difficult to generalize, and to me to talk about Europe as a whole is probably misleading because the big differences in Europe. The majority of my investments in Europe are in the Nordic region and in the UK. I have a difficult time finding value. There are a lot of cheap stocks, but not necessarily great value in some of the more developed markets like Germany, Spain, Italy, France. So those stocks actually look cheap. The PE multiples aren't that high. In some cases, the dividend yields are okay. But in many cases, those firms have structural problems where they deserve to be cheap. So although Europe as a whole looks cheaper than the US, as a whole, I would say that it doesn't offer as many buy and sell opportunities for me, and it doesn't offer as many buying opportunities for me as the US does. And in terms of specific industries, the telecom sector would be one that I would spend a lot of time on because they are generating enormous amounts of free cash flow. These companies built up huge debt positions, and they got into a lot of trouble, and the equity market cap of these stocks declined dramatically. And as a result, managements have now determined to clean up their balance sheets and pay down their debt. And that is a sector that has an enormous amount of free cash flow. I would stay away from companies that are exporters or who have dollar revenues because with the euro where it is today, it's a huge drag on corporations over there. You go over there, and if you are in the paper business and you basically paper is bought and sold in dollars, and a lot of those companies have costs in euros. If you're in the oil business in Europe, your oil is priced in dollars, but your cost might be in euros. So any business over there that has dollar revenue but local cost, I would be very careful about and I would analyze because earnings estimates there are probably going to come down. So to me, Europe is an interesting place. It's changing. I think when I wake up in the morning and I say what's different this time, I think one of the things that's different about Europe is that on May 29th, the French vote on whether or not they're going to ratify the European Constitution. And then 3 months ago, about 60% of the people polled said they'd vote for it. Today, 55% of the people said they won't. That's huge to me. And it's one of the reasons why in my portfolio, I have my entire European currency exposure hedged back to the dollar. I don't want to be long euros right now. Everyone seems to be long euros. Nobody likes the dollar. To me, it's too risky to do. So rather than take that risk, I can sell foreign currency forwards and offset any currency exposure I have. And basically, my investments in Europe are going to go up or down based on whether or not the stocks go up or down. I won't gain anything or lose anything if the currency moves. So that's one risk in the portfolio I want to get out of, and I have gotten out of it.
You hear about the 100 stocks, 20 different sectors, 20 different countries. I mean, how do you know and understand all this? I mean, like value investors talk about know what you know, and you don't know everything, basically. I mean, it seems that you seem to know everything.
That's what my wife tells me too. My wife always tells me I'm a know-it-all. I know everything. No, when I was at Templeton, I was in charge of the research department, and I grew the research department from 12 people to 70. And I sort of understand what it takes in terms of personnel to manage research and research department. And basically, you can, depending on the type of name, how comfortable you are with the sector. One of the things that I did at Templeton when I took over from Sir John used to have us cover countries around the world. So I was the Spanish analyst for a while, and then I was the French analyst. And everyone who managed money at Templeton covered a country or several countries. I kept that, but I changed the research so it was sectorally, globally. So you were the bank analyst for the world. You were the metals analyst for the world. You were, the auto analyst for the world. And we overlaid that with the country coverage. The reason why I say that, most people who work for me grew up in the Templeton system. About every 3 to 5 years, we would change research responsibilities. So in my career at Templeton, which spans 20 years, I've covered over a dozen countries and or industries as the analyst responsible for that country or industry for the entire Templeton organization. And every 3 or 5 years, I would change and take on something new. I made people shift because I wanted them to be, I felt that you get fresh blood in, it's better to do that. And I found that basically analysts can cover anywhere between 15 to 35 names, depending on their comfort level with a sector or country. So in our shop, we have 6 people who are dedicated analysts. We also have, and we have about 100 names total in our portfolio. But for example, that Bertelsmann trade, in order to put that Bertelsmann trade on, you have to have exposure to 5 names. So that's 5 names basically in that one arbitrage situation. In the arbitrage part of our portfolio, a lot of the arbitrage is basically simple math and finding when these disparities occur in the portfolio. So I have a trading desk that has 4 people on it, and only about a third of their time they're actually trading securities around the world. We have to run a 24-hour trading desk. The rest of their time they maintain and help analyze equity arbitrage opportunities around the world because they're mainly math and trading related type trades. So they look at all the mergers. They have a list of every single merger that's been announced anywhere in the world. It's on a database. It's priced in real time. If you asked them for it right now, they'd send it to you with the prices as of right now. It shows you any spread that's there. There's a little commentary that shows you the closing date of the merger, legal impediments, regulatory approvals that need to be done, et cetera, et cetera. So they have a spreadsheet of every merger in the world, and it blows out to a certain spread. It triggers something on the computer that tells us we need to focus on it. They have the same thing for all the holding companies that we can find over the world, all around the world, and they have the same thing for all the share class arbitrage. So you can, 100 names is not a lot. We also invest, when we invest, we hold our investments for on average about 5 years. So it's not like we have to come up with 100 new investments every year. We only turn over roughly 15 to 20% of our portfolio in a year. So that's not a huge amount. So when I ran the Templeton Foreign Fund, I had about 300 names in the Templeton Foreign Fund. But that was only, that's one of the reasons why I quit. Because, when I took it over, it was a $1.5 billion fund. When I got out of it, it was a $17 billion fund. And I was getting a couple $100 million in, every week. And I couldn't, as a portfolio manager, cover those 350 names, even though I had all the help to do it. So I just had to walk away from it.
350 names, buy the MSCI index and you're good.
Well, you can't charge good fees for indexing. Somebody had a question.
I was curious that you had the pharmaceutical industry as one that you're sort of hot on. When I look at the pharmaceutical industry, I see companies that have just completely decimated their pipeline, got nothing there. There's like products are going off the list faster than they're getting on, and it just seems to be like a desolate environment, and you seem to be keen on it. So I'm curious as to.
I think that's the general view of pharmaceuticals, and I would say that's probably true with more than half, maybe 2/3 of all the pharmaceuticals. So what do? We go to look at the pipeline. We have a relationship with an attorney who's a specialist in the FDA on drug approvals. And he's very helpful to us. He's sort of a consultant. But we take a look at pipelines, the likelihood of drugs being approved, where they are in the stages of approval. We get a sense of the size of those drugs, the potential size relative to the market, whether it's a diabetic drug. We know what the size of the diabetic market is. And we basically say, okay, this is a drug that does this, this, that. The probability of it actually getting approved, we take that probability and multiply it by the potential size of the market and its share of the market. We figure out what margins they've traditionally had in that business. We discount it to be conservative. We have a huge spreadsheet. We take all that and we discount it back to today. And in the case of a company like GlaxoSmithKline, we don't think the market's actually giving them credit for their pipeline. There are some companies where they have a huge problem, not only in their pipeline, but in some of their liability issues. Not every company has a liability because they have a drug that's been pulled. It's a great opportunity to go on and look at it. So, yeah, about 2/3 of the companies in the drug sector, I would agree. But that it's like the whole industry is being tarnished by that sort of reputation. As a result, it offers opportunities. So the thing when you have to look at it, when you invest, is not are there problems, but whether or not the problems are already reflected in the price. And price is very important.
Yeah, just spend a lot of time
You know, it really varies. I mean, there's a lot of countries where maybe we haven't been recently. We're finding things in the work that we do. I mean, Japan was like this a year ago today, where we were finding a lot of companies that are selling below the net current assets. You know, if you take current assets minus current liabilities, less all debt, that was bigger than the market cap. That was, you know, there was a lot of them, but they were small. So basically, you know, there's not many times you can buy a company on a net basis like that. And Ben Graham used to say that's how you should invest. Current assets minus current liabilities, less all debt. And if you have a number, and that's bigger than your market cap, that's really interesting. So in the course of doing screening, which we do a lot of, we were finding a lot of these. So we did a lot of work for about a month on these names. A lot of these companies were losing money and were shrinking, or, you know, so we try to find a qualitative system to weed out those problems. And then we came down a list of 20 names, and then we went to Japan and we visited 15 of them. Try to find out if they're real companies, is their information accurate, you know, what are the dynamics of this company. So it really varies. I mean, if we're going to visit a company that we already have an investment in, I'm going to see Comcast tomorrow. I'm going to see the entire management committee of Comcast. I'm going with Nicholas Brady, the former Treasury Secretary, one of my directors who's organized the meeting. Our principal goal there is to try to understand from them how the cable business and the phone business are changing. Basically, the cable companies in America are competing with the phone companies, and the phone companies are trying to compete with the cable companies. SBC is going to offer you cable. Comcast is going to offer you a phone. And they're basically going to be competitors. So we want to go and visit Comcast to try to get a sense from them. That industry is changing so much. What does the change mean? That type of visit is more trying to understand the industry and the dynamics in the industry, which will make us better analyzers of specific companies. So it really varies. Most of the time when you go and visit a company, you get very little information on that company that's useful. You get phenomenal information on the industry, and you get outstanding information on their competition. And it's the best way for you to get a sense of what's going on in the industry and the competition is by going and visiting somebody else. They're going to tell you everything they want you to hear. But they'll be brutally honest about their competition, and they'll be brutally honest about the sector.
You're running out of time. Jim is going to get up sometime.
Yeah, I was just wondering, what part of the research do you get from external sources? Do you depend on other, do you outsource any of the research, or do you rely on your assets?
We get research whether we want it or not. It comes in the door. It's about this much a day. It's unbelievable how much research is out there. Where do we get it and what's useful? We get it from brokers, whether we want it or not, but having got it from the brokerage community for 20 years, you know, you can sift through brokerage research this high in about 15 minutes and get to what might be useful to read, which is mainly company-specific stuff, spreadsheets. We don't necessarily want a broker to tell us if a stock's a buy or a sell. We'd like to see their spreadsheets on what their assumptions are and how the businesses are changing, et cetera. We go and visit managements like we're doing tomorrow. We get an awful lot of information that way. We hire outside consultants. I thought RIM might be a good short because RIM had a liability issue where they had some patent infringement lawsuits against them. So I'm not a patent attorney, I don't know anything about it, so I hired a patent attorney. And to me, RIM was a good short or a bad short based on this issue of the patent infringement. And the best way to do that was just to hire a patent attorney, which we did. A guy who specializes in cellular patents in the US. So we hired him, and he basically analyzed that for us. We determined it was too risky an investment to short. So we'll use outside consultants like that. We piggyback on a lot of arbitrage groups. In order to be involved in merger arbitrage, there's an enormous amount of legal work that needs to be done, whether or not the European Union will approve a deal, or there are other regulatory issues to consider. There are really big arbitrage groups out there like Bear Stearns, Goldman Sachs, that'll carry on a conversation with you and share legal opinions with you because they want your opinion on the legal opinion. To them, that you can add value. They don't mind if they've hired a lawyer to analyze a particular merger and they give you the legal brief because they know you'll read it and you'll call them up. And if you don't, you won't get the next legal brief. So people actually share a lot of information in my business. I sat with another portfolio manager, and you have to be very careful when you do that because there's all sorts of regulatory issues associated with that. But I sat with a portfolio manager a couple of weeks ago who also had an interest in the pharmaceutical stocks and sent me his analysis of a company's drug pipeline. and I in turn sent mine, and we tried to figure out how they differed and why. So the great thing about this business is that you can get information from anywhere. There's so many sources of information. The best place to find ideas, though, is where there's limited information. The least amount of information, the biggest potential there is for a discrepancy in valuation, which is why international investing is so much fun. In that case, you got to get on the airplane, you got to pack your suits, and go out and start kicking the tires. I once went to look at a watch factory in mainland China that wasn't even there. Anytime you have a period where you have excess liquidity in the system, emerging markets tend to do very well. And there was a lot of money that went into emerging markets, both the equity and the debt markets, as a result of the global liquidity that was out there. And that is changing now. As I mentioned before, one of the things that I think is different this time is that global liquidity is changing. The liquidity is coming out of the system, and those are the markets that probably will react very quickly. And if you notice over the last month or so, markets have been very volatile. I think since March 7th, the S&P or the Dow is down something like 5 or 6%. And if you look at some of the emerging markets, they're down even more. And if you look at emerging market debt, they're off even more. So I actually think from a political perspective, from a company perspective, the risk there is not as important as this issue of global liquidity and the fact that global liquidity is shrinking. And to me, it makes the emerging markets very risky. So it's once again, how do you look at risk? How do you analyze risk? You might find an investment in Brazil that might be very interesting, but if the global community thinks that liquidity is changing, and in their portfolio they need to become more conservative, the first things they pull back on are not, unfortunately, IBM or GE. They pull back on Petrobras and, Petrofina and other stocks and markets they consider to be less safe. So in the short period here, I actually think emerging markets are quite risky because of this issue of global liquidity.
I'm curious if you use a lot of leverage on the fair trade and also on, merger arbitrage. Is there some formula for figuring out what's going to close and what is not, or you don't
Now, we use leverage only to the extent that we're short. We don't lever positions. We don't borrow money and lever up.
what are your spreads typically on those fair trades?
I mean, it varies, but we're trying to make 20% returns on average on our pair trades. Yes. Now, about 2/3 of them work. About 1/3 of them don't, so that means our actual return is more in the mid-teens. And your second question was?
On merger arbitrage. I know a lot of value investors have been successful with that.
Oh, how do we determine? Yeah, I mean, there's so many variables on merger arbitrage. Really, we look at merger arbitrage in terms of cash alternative type returns. We get active in merger arbitrage when actually there's a low probability that the deal won't get done, or i.e. there's a high probability that it will get done. What we try to take advantage of are people like what I used to be. If I was a long-only portfolio manager and I held shares in, YPF in Argentina, which was being taken over by Repsol in Spain or whoever it was, and I was going to get their shares, and there was a 3% difference between the value of my shares and what I was going to get, but maybe I didn't want to have those shares in my portfolio, I would just sell. Because to me, that's the only thing I could do as a long-only portfolio manager. As a hedge fund manager, I can say, okay, well, that guy's willing to give up that 3% return. He can't hedge away the risk of that security that he's getting by shorting it. I can. If it's a 3% spread and the deal closes in 4 months, that's a bloody good return if there's a high probability that the deal will get done. So what I'm looking for as a hedge fund manager in the merger arb space is only 1 or 2% spreads, but 1 or 2% spreads that I can capture in a very short period of time, where there's a high probability that the deal will close. And to me, rather than earning 2% on my cash over a year, I'd rather earn 1 or 2% over a month. That's what I consider cash alternative type merger arbs. There are other people that where the spreads are 15 to 20%, and there's great risk to the deal not getting done, and they hire reams of lawyers, and we look at all that stuff, but we're really more interested in the cash alternative type merger returns. Thank you very much. I really appreciate it.